Welcome to the Foundry, where leaders are forged daily. I'm your host, George Roberts. Welcome back, entrepreneurs. Today we have Bernard Reisz, founder of ReSureFinancial. Welcome, Bernard.
Hello, George. I am honored to be here. Been looking forward to this discussion. We've had some great interaction the last couple of days, and this is just a great way to keep that going.
That is great. And before I go into that, how did I do on the name?
You got it spot on. Kudos.
Thank you. So yes, Bernard is referring to Yonah Weiss and his virtual meetup, a great meetup. What is it? Wednesday at, is it 8 Eastern?
I think it's 7 Eastern.
7 Eastern. Okay. It's a great thing. So if you haven't been there, go check out Yonah. And some great interaction. I know Bernard has a great story to tell today. I know a lot of us are interested in becoming passive investors in a syndication. But before we get to that, I'd like to ask Bernard about ReSureFinancial. So tell us the origin story of your company.
Yes, it is really, I'll try to give it to you in a nutshell, the short version, and then I can elaborate a bit. The short version is I was out there doing stuff as a CPA and working with clients and seeing that the financial industry was dominated by folks selling products and really not delivering complete information. So be it a financial product or a tax product. And I was determined to provide an avenue for folks to get information the way it is, get educated, and really empower them with their financials. The rest of the I wouldn't say the rest, but a lot of the financial industry out there is built on fostering dependency. And we wanted to empower people, empower them with information, empower them with control of their money, empower them to pursue things that they wouldn't otherwise be brought to their attention. And that is what ReSureFinancial is all about.
Yeah, I love it. I mean, we're not going to mention any names, but the big guys, if you ask them, hey, can I do this with my IRA? Yeah, they tend to say no. And you've got to find the right people. And, a lot of the times, if you look, they're out there. And obviously ReSureFinancial is one of those players. So let's say that you want to get into some alternative investment. It doesn't have to be private equity. It could be anything. Like Bitcoin is really popular these days. You really can't do that with the sort of retirement accounts that you can set up with those big guys. So maybe you could walk us through a couple of the types of accounts, maybe your favorites or the ones you think that might be most helpful to our listeners.
Yes. And I think I'm going to preface this by saying that I don't really have a favorite because, again, the key theme is there is no best retirement account. It really varies from investor to investor, looking at both their tax profile, because these are essentially these are creations of the tax code. And so the tax code has given us so many forms of retirement accounts because not every single one works for every investor. So it's really about matching it to the investor and the asset class that we're doing. So if anybody is out there saying, hey, this is the best retirement account, it's just impossible, because what you need is the best one for you, and you are unique. So you are unique while we have, let's say, a dozen or so versions overall of retirement accounts, one of those is going to be the best fit for your profile and what you're trying to do. Does that make sense?
Absolutely. So how about a couple of hypotheticals? Like, let's say you have a lot of money in various IRA accounts, but they all happen to be Roth. I believe there's certain options that might be disallowed in that case.
Yes, spot on. And so let's back it up so that folks know what the different retirement accounts are. And then we'll be able to get to the more specific scenarios. So at the highest level, there are two groups of retirement accounts in the tax code. There are qualified retirement plans and individual retirement arrangements. Any idea what the abbreviations or acronyms for either of those are?
Hit us.
Qualified retirement plans would be abbreviated as
QRP.
individual retirement arrangements.
IRA.
You hit the nail on the head, George. So broadly speaking, those are two groups of plans. Now, what distinguishes those two groups of retirement plans is, again, just going to the basic ground level, ground zero of what these are. A qualified retirement plan, and we'll just say QRP, it's easier, is a benefit plan that's established for employees or self-employed individuals, right? And so we all know what a QRP is. Almost all of us have had one at some point. We've participated in a company 401k plan. That is your quintessential qualified retirement plan. Now, QRPs can come in many versions. You can have a defined benefit plan, cash balance plan. There are many types of them, but the type that you're going to encounter most often is going to be a 401k plan. But the truth is, based on your particular profile and what you're trying to do, one or the other, or even a hybrid or combination of all of these and integration of them can be the best fit. But that's at its core, QRP established for the benefit of employees. Now, IRAs, those are individual retirement arrangements. And as their name indicates, it's a plan or a trust established for the benefit of an individual. So to think about it this way, who can establish a qualified plan? It's got to be some sort of business that has employees or self-employed individual. Who can establish an IRA? Any individual. So that's at the core of what distinguishes QRP from IRA. Make sense? Any questions about that?
Yeah, that's perfect. So let's hit it like this. So your QRP, let's say you have something like a podcast, something that could produce revenue. Maybe you have an LLC, but the revenue's not there yet. Is there any way that you can get a QRP in that situation?
You're asking a tough question, and I'll tell you why. Some of the considerations there. An LLC is meaningless, really, for the most part, right? What you need is what the tax code defines as a trade or business. An LLC really has nothing to do with trade or business, right? You can be run, theoretically, you can have a $1 billion business without an LLC, right? And that's a business, right? Whether or not you've got an LLC. And if you've got an LLC, but there's no business activity, then you don't have a business. An LLC is just a legal construct, right? That gives you liability protection. But if you're not running a business, it's absolutely meaningless. Yes, and I am aware of folks out there that are saying set up an LLC and then you can have a QRP. It's got nothing to do with having an LLC. So it gets into what is a trade or business. A trade or business is something that the tax code does not give us clear guidelines on. It's something the IRS has for decades said, we're not giving you rules to define what is a trade or business and what isn't a trade or business. What it boils down to is facts and circumstances. So if you would look at it, for the most part, there are certain things, right? If somebody establishes an LLC and has no business operations, there's no trade or business. If somebody has something that is clearly they're buying and selling, they're generating revenue, it's something that they're doing on an ongoing basis, we'll all recognize that as a trade or business. But there are things that will fall into a gray zone, and we really cannot give you answers. The IRS says, hey, here are like a list of stuff that we're going to look at to determine if this is a trade or business. But there's no hard or fast rule. Oh, spend 8 hours a day on it. No, you don't have to spend 8 hours a day on it. But we can be pretty sure that if you spend 8 hours per year on it, that it's probably not a business, right? So nobody can give you a definitive, conclusive answer to that question because it doesn't exist.
Well, then how about types of QRPs? So I'll just throw out a few that I've either had or considered, like say a 401k, a SEP, or a simple. So these are QRPs.
So a 401k is a QRP, SEP and a simple are not. So I know this gets a little confusing, so I love the question. Excellent question. So a SEP and simple, it's a bit of a hybrid, but essentially what those are is and say you've got a business, right? And there are 10 employees. Each employee with a SEP plan, SEP IRA or a simple IRA, every single employee has their own IRA. And the SEP just allows the business to contribute to the employee's IRA. So where does the money actually go to? It goes to a good old IRA. But rather than the contribution coming from the individual, a SEP allows the business to put money into your IRA. So what you end up with, where's the money sitting? In an individual retirement arrangement, right? And in a trust established for the benefit of an individual, the SEP component just lets the business put money into my individual account, as opposed to a qualified plan where the money is sitting in a trust that is not an individual trust, but rather a trust established for the benefit of employees.
That's an excellent distinction there. And thank you for clearing up that confusion, a question I think a lot of people may have. So then you covered QRPs and some of the distinctions between the plans and why some may look like a QRP, but they're really an IRA. Tell us about an IRA and how that's different.
So IRAs, there are much simpler. IRAs are really, the beauty of IRAs, for the most part, is their simplicity. Qualified plans have incredible complexity associated with them, but that also does create additional opportunity. So the two go hand in hand, opportunity and responsibility. And it's very important for people to be aware of that relationship, that dynamic, because when you do set up a QRP, if you have to be ready to embrace that complexity and be aware of it. Whereas IRAs, simplicity is always something to look for, because complexity can create all sorts of unintended consequences. And if you don't benefit from the complexity, there's no reason to have the complexity. It just creates pitfalls with no upside. So there's a price to pay for having the increased opportunity and flexibility of a qualified plan. But the question is that opportunity and flexibility, is that something that's worth something to you, right? And at what price? So it's a mistake. So while a qualified plan has some bells and whistles, it may not be the best for you, right? Does that make sense?
Yeah, it totally makes sense. And even, within the realm of setting up retirement accounts of various types, in businesses that I've had, there's obviously some that they're nice, but you want to have, say, 10 to 100 employees. If you got 1 to 3, it's a different story. If everybody is equity, that allows certain things, and some of them have rules like top heavy. I'm sure you could go on and on, wax poetic about all that.
Yeah, most folks, when I say top heavy, ACP testing, ADP testing, they have no idea what I'm talking about. So I'm pretty impressed.
Well, thank you. I don't know why. I mean, maybe I have a mutant gene in me someplace, but I do find the tax code fascinating. After all, the more you know, that's power. I also like reading operating agreements. That's when I talk to lawyers, they're like, really? Nobody, we don't like reading these things. But it really is, you know how to read an operating agreement. I mean, that's how your business is going to function legally. And so I just find it fascinating. So same thing with the tax code.
Yes, it's so well said. I think we may have a lot in common. I read a lot of code and a lot of legal stuff. And for the folks out there, that may not be aware of that. Your operating agreement, yeah, it sits in a drawer, but when the rubber hits the road, every little nuance in that document can make a difference. So you want to know what it says.
Absolutely. My favorite thing to say in any arguments is when somebody says, well, let's see what the agreement says. Oh, that's the moment it gets interesting.
Yeah, and a lot of people get into stuff and they're, you think that the document is something you don't have to look at. It's a formality, and hopefully it is just a formality. But the reason you get the documents in the first place is because it may one day be more than a formality. So documents are important. So yeah, we probably have a lot to discuss beyond what we can get into today's discussion.
I love it. Two people having a lot of fun talking about the tax code. So one of the things that you can do with these various types of accounts, and I'll just let you throw out, whatever you think might be the most important, but I think most people know about a self-directed IRA. If you've ever heard of someone say like, oh, you can invest in real estate and you can invest in gold and Bitcoin, they're probably talking about a self-directed IRA. So why don't you start there and tell us what that is, what you can invest in, and maybe some costs and benefits.
Yeah, let's do it. So retirement accounts, really, for the most part, regardless of which category they fall into, the Congress and the IRS, in principle, they're not looking to play investment advisor, right? And they're not looking, and this is like axiomatic with tax rules, they're trying to be economically neutral in all scenarios, unless they're specifically out to create an incentive, right? So when retirement accounts were created with their tax benefits, they didn't really say, it doesn't say anywhere you can invest it in assets A, B, or C. Right? What does it say about what assets you may invest in? George, any idea?
That it says that you may invest in? I only know the two that you can't. You're not supposed to invest in liquor or Picasso paintings. Those are the big things that I'm aware of. You can't consume it, and you can't. It can't be a collectible. But I don't. As for what's specifically mentioned, I don't know.
And so you're spot on. That's an awesome answer, because nothing is specifically mentioned as allowable. That's exactly it. There's a couple of stuff that are not allowed. And so those are the collectibles, precious metals. Precious metals is a very broad topic, because yes, you can invest in precious metals, right? But it's like a special carve out, a lot of rules, but no collectibles for certain plans, no life insurance, for IRAs, no life insurance. But for the most part, that's it. Right? It doesn't say you can buy mutual funds. It doesn't say you can buy ETFs. It is really silent about what you can invest in. So from the perspective of the tax code, really from an asset class perspective, everything is allowed. Now, the reality is, so whether you're using qualified plans or IRAs, though, there can be all sorts of hurdles to actually pulling that off. Now, some of those hurdles are administrative, right? Because it's much easier to be a financial institution and run an investment platform like the big brokerage houses, right, where people buy mutual funds, than it is to run a shop where your people are buying and selling real estate. That's a very manual process, very labor intensive, right? It's not easily automated, right? So you can have some hurdles to actually, okay, how do we do this? Right? I can't do it at brokerage. Schwab and Vanguard are not going to let me buy real estate, but it's not a tax code thing. It's just a technical hurdle that you have to get by. The other side of it is the tax side. Yes, it is true that the tax code does not disallow buying real estate or cryptocurrency in tax sheltered retirement accounts, QRP or IRA. But there are all sorts of other little wrinkles in the tax code that can make it hard for you to do it, or that that you have to think through in order to do it optimally. Does that make sense?
Yeah, it makes total sense. I wasn't sure if there's someplace you wanted to go after that, because otherwise I've got a question for you.
Yeah, toss out the questions. I love questions.
All right, so then, yeah, so your self-directed IRA, just tell us like what it is, Is it hard to set up? Is it hard to use? What I'm kind of looking more for experience, and I understand maybe you're more kind of like on the theoretical, like this is what's possible. If you want, I can fill in. I'll tell you my own experience with them. They're an interesting beast.
Let's hear your experience, and then yeah, we'll transition to that. But I love using your
Okay,
real life
perfect.
experience.
So what I would say is I'm not here to give you advice. I'm not qualified to do that, but I will share you my experience. And my experience is that if you want to invest in any of these things, whatever it is, precious metals, Bitcoin, private equity, real estate, make sure that you set it up now. Set it up now, because you're going to be surprised at how long it takes to set up. And once you do set it up, you may have a long wait. And so I've heard people doing different things. Like I heard one guy tell me, hey, invest in munis. Okay. It's nice. It's tax free. You get a decent return. Usually it's a little bit better than what you're getting from, obviously treasuries, which have the backstop of the US federal government. Remember though, there was a city that declared bankruptcy a few years back. So you could lose all your money with that. That could be dangerous. But yeah, munis, fair enough. For me, I just like the S&P 500. And, I can go and get the same index fund that I get when I work with my major brokerage house, which, by the way, I am just loving everything that Bernard has to tell us about these alternative ways of going. But I've still got, I'm working with one of those big players. And hey, if I'm just trading stocks, that's perfect for me. But then in my account, I don't have a deal every day, right? It takes a long time. So I just like to stay invested. So I choose something like the S&P 500. Somebody else might choose bonds. The great thing I found is that, at least where I'm set up, if you're using something like a mutual fund, or maybe I think even an ETF, they'll trade it for you. They'll clear it for you. But if I want to trade a stock, it's like, oh no, we have to send it out to the brokerage. The brokerage will clear it for us, and then they'll send the money back. And I'm thinking, oh yeah, that sounds like a lot of fun. So if I'm going to trade stocks, I do that with the big guys. And then when I'm interested in doing something in private equity, I do that in the self-directed IRA, but while I'm waiting, I just do something simple. I'm not going to trade any stocks in there. And I'll tell you, the first time I got into a private equity transaction, it was private equity real estate, better known as a syndication. And wow, it took a long time. And the syndicator helped me a little bit because I couldn't seem to find their operating agreement, which I think had a different name because it was in Texas. Or no, not even no, it wasn't the operating agreement. It was the Articles of Organization. That's what we'd call it in Michigan. But it was called something different over there. So I said, could you send that over? And she was great, sent it over, and it worked. But I tell you, the first time I did one of those transactions, it was nuts. Titling everything correctly. I actually have a document. It says, if you want to do this, this is the procedure. You want to do that? I'm sure it's on their website at some point, but yeah, it's pretty crazy. So, the first time I went through it, it was hard. But you just got to be committed to the process. If you really want to invest in these things, you can do it. And you just have to go through the process of doing it. Now, the second time, it was awesome. I knew how to title everything. I had written myself a little protocol. I followed the protocol. And, the only thing that went wrong was they had to verify that I was accredited. And so I wrote to my CPA. Oh, here we go. Here, I got a question for you about this. I had to write my CPA to see that I was accredited. And the CPA just read the rule wrong and said that you aren't. And I had to explain the rule and I had to come back. So, okay, so here, we're going to pause this for a second. I have to ask, dealing with CPAs, Bernard, my experience is that they're wonderful people. They know tons of stuff, but they're not very forthcoming. Usually in my experience, it's like, I've got to study the code. I got to know what to do. I have to make my plan. And I come to the CPA and say, am I right? And at that point, they're a fountain of information. But if I don't ask the right question, I just don't get the answer.
Yeah, so much to say. So here's the deal. CPAs come in various flavors. But overall, it's an industry, and I don't want to blame the CPAs. It's really a dynamic overall of financial industry. Overall dynamic. Folks want to buy a product, and that is why, right? So it has become CPAs sell tax returns, right? So if you were to tell your CPA, and again, suppose you have the right CPA for this, I just want to pay you for your advice, right? So firstly, you'd have actually more CPAs that are qualified to give advice. The reality is today, most CPAs are great at producing tax returns and knowing how to put information in the right boxes on the tax return, but they don't spend time reading code or case law or revenue rulings, right? And they learn their tax information from doing tax returns. And a tax return is really like a million miles removed from the source, right? The source is revenue rulings, code, regulations. That's where they learn. And so some CPAs actually do real research. Most do not. But at the same time, being that people want to buy a tax return, the industry is such that CPAs are selling tax returns. And almost any other information that you're getting from them, you're kind of getting for free, and they're giving it to you just so that they can keep the tax return. So that's a dynamic. It would be wonderful if that changed, because I think we would get better CPAs and better tax outcomes for people, and people would be more forthcoming. Financial products is very similar. Retirement accounts is a great example, right? People in this space, for the most part, right, are getting their retirement account set up, be it QRP side or on SDIRA side, by buying paperwork, right? There are very few people that are actually saying, hey, let me go find an expert in this space and pay them to advise me and figure out what's the right thing for me, right? And so the way ReSure was set up, right, initially we were doing kind of like the setup process. And then we rolled out, we realized, hey, people need advice here and they're not getting it. We said, okay, you can retain us to give you advice. You got your QRP set up by company X, your SDIRA company Z, you just need advice. Here, we have an hourly rate. And then we realized that, hey, we're catching all these mistakes or things that were not done optimally, and we can't go fix them. We just can't get back in time and fix those. Right? There are penalties, there are questionable transactions, or like you did this set up in a QRP and you should have had an SDIRA or vice versa. And we're like, okay, we just have to make a more expansive process from the get-go so people get it set up optimally in the first place. And it's really unique in the space. There is, at least for the moment, any other kind of vendor you go out there that's going to help you with setting up a retirement account, that's essentially selling you paperwork. When people sign up to work with ReSure, they're really signing up for an integrated service. They don't sign up and say, oh, I'm getting a QRP, I'm getting a solo 401k, I'm getting an SDIRA, I'm getting a checkbook IRA. They're like, hey, we're just going to take you through this with our expertise and our industry knowledge. Yeah. Oh, if you determine that you need checkbook control, our fee our flat fee includes setting up the checkbook control. Where should we put that LLC? We'll help you figure it out. And we'll set it up for you. And there's no additional cost. It's all integrated in that one fee. Oh, we need a solo 401k. That's included, right? No additional fee. We just set it up for you. So we integrate that expertise with the setup. So we try, and people are not just selling the paperwork. So to bring this back to your question about CPAs, this theme that folks are buying products rather than getting getting guidance is something that is very prevalent in the financial industry.
So that's perfect. I kind of set you up there because I figured you'd say something like, well, you get what you pay for. And by the way, if my CPA is listening, you are loved and appreciated. But it's fair to say is that I'm not in that sort of a relationship.
Right? I guess that was all recorded.
Where I'm paying for advice and things like that. I'm paying for the tax accounting, and that's great. But you're obviously doing a completely different level of service. You're looking for the clients that want that higher level of service. They don't just want the tax returns done properly. You want to tell them, how to save money on their taxes, even to set up how they're set up their LLC properly. So that sounds like you're really going way beyond
no, I'm all over the place. And I would not want to conflate what I'm saying with what you pay for, because that's also something that a lot of folks that charge exorbitant prices Nothing. Love to say you get what you pay for. So it actually, from what I've seen, right, there are wonderful people in the financial industry, and the best ones are never the most expensive ones. They are usually, that is, as a general rule, what I have found is the best ones, yes, they're not going to be bottom of the barrel, but they are going to be providing immense value relative to their fee. If I'm allowed to digress, because I don't know what the questions you're going to ask at the end of this interview, but a classic question that I get, and right, I've been on a lot of podcasts, as you know, is like, how are you giving back? How are you adding value? Right. And people are always like, oh, I give some charity, or I don't know, different stuff that they do. The reality is the good people try to add value in everything that they do. And there's this perception like, oh, your business is maybe where like you make money and you add value through some other extracurricular thing that you're doing. The best folks out there are the people that try to add value in everything that they do. And one of the ways they view their business as a way to actually deliver immense value. So you're going to find those people are going to be over delivering relative to the fee that they're charging. And you're going to have folks out there that are going to love to say, oh, you get what you pay for. And they're going to be overcharging for something that you probably shouldn't even get in the first place.
I like it. I love that philosophy. So maybe you could take us at this point. I know you did talk a little bit about self-directed IRAs. We haven't really contrasted that with other types or other vehicles. Is there anything you'd like to contrast that with?
So the contrast is with QRP and some of the subcategories, right? So solo 401k is something you mentioned earlier. Mm-hmm. So solo 401k is a bit of a sweet spot when it fits. So a qualified retirement plan, again, just a category of plans for employees. Now, if you have a solo QRP, it sidesteps a lot of the complexity that QRPs have. And that is a bit of a sweet space to be. They have more complexity than IRAs, but they have more flexibility and some unique, attractive tax features. And so you get a lot of the upside of QRP with very little of the downside. So a solo QRP, for those that qualify, is the sweet spot. The challenge out there is, firstly, let's define what is a solo QRP and what is not a solo QRP. What is an ERISA QRP and what is not an ERISA QRP, right? So what makes a solo QRP attractive is that it's not subject to the full brunt of ERISA. So it is true, yes, a solo QRP does not have the full asset protection benefits of an ERISA QRP. You know, it does not have that, but it's a pretty fair trade-off. Now, it's a sweet trade-off to have. Again, nobody has a crystal ball, but the likelihood of somebody actually benefiting from the additional layer of asset protection is slim, and the likelihood of benefiting from the removal of the QRP ERISA complexity is a certainty, right? So you're getting a certain benefit, not being subject to ERISA, and you're, of all that complexity, and you're giving up, some of the asset protection component, a sliver of that, which you probably won't need anyway, right? Asset protection is kind of like insurance. You want to have it, but right, just like you would not pay the certain price that you pay for your premiums above a certain amount, you say, hey, this is probably not going to happen, so I'm not paying $50,000 for the policy because the benefit is not there. Likewise, asset protection, it's like an insurance policy, right? You're probably not going to need it, but it has value to have some protection, but the value has to be, again, the cost benefit, right? Am I going to need that? Probably not, but I may, so I want to pay something for it. So I think being free of ERISA is a huge benefit, and that's what a solo QRP has. Now, a solo QRP, no matter what makes something a solo, whether you meet the tax and labor law definition of solo. And so if you meet that definition, nobody can tell you, oh, here's an ERISA QRP. It is not an ERISA QRP if it is a solo QRP. If you have employees, it is automatically an ERISA QRP, even if somebody says it's a solo QRP. And that is where some of the key danger in the solo 401k QRP space lies is, are you a solo or not? Are you in solo space or in ERISA space? It's not the piece of paper that determines, it's your tax profile that dictates. And so there are people out there that think they're in solo QRP and they're really an ERISA QRP. That's a pretty punishing place to be from a tax perspective, because all sorts of penalties associated with that. But then there are folks that think they have an ERISA QRP and they may not even have a QRP at all, right? Because you can imagine if somebody does not have, if you don't meet the definition, right? What is the definition of a qualified retirement plan?
So that has to be for the benefit of employees.
Or a self-employed individual, right?
Or self-employed.
Right? If you don't meet that definition and you have a piece of paper that says QRP on it, it's not a QRP, right? The piece of paper is really immaterial. It's the overall tax reality that dictates. So this is where like people are out there, what's the best plan? Well, there is no best plan because it's going to be varied based on your particular profile and the realities of your profile.
Awesome. So we went through self-directed IRAs and solo QRPs, and suffice it to say that there are many variations, many vehicles you can do similar things with, depending on your circumstance. One may be better than the other, but probably better to move on to our next topic and just walk us through how we would use one of these to invest in something like a syndication.
So in a nutshell, you're ending up with your money in a legal entity, right? It's either ending up in a trust or in an LLC, because there are different ways we set these up, right? So some of them may end up in a trust. Now, again, because every retirement plan, an IRA and a QRP have a trust. That's really what they are. And then we may or may not add additional entities underneath that. So you may have an LLC inside your QRP or IRA, or you may have another trust, a sub-trust. So there are many, but ultimately it's ending up inside of a legal entity. And when you invest, just as you would invest with your own money, and maybe you would sign off on the documents, George, as the subscriber. Well, over here, you're just signing off. No, the investing entity is going to be this trust or LLC, and you're going to be signing in your capacity of trustee or LLC manager, or whatever your authority is. So it really is straightforward once we get the concepts all sorted out. The retirement account thing tends to put a wrinkle in there in people's minds where it doesn't really have to be there. Essentially, it's investing through an entity that has, and incidentally, that entity has some attractive tax features. But take away the tax component, when you're signing on to an investment, that's a legal transaction. And so just like you put aside the taxes for a moment and just think about it from a legal mind. Okay, trust, how do we sign? Oh, a trust signs off like this. The trustee signs as the trustee. Well, in an LLC, who signs off? Whoever the authorized party of the LLC is. And so it really can be very simple. Now, if you've got a custodian involved and a custodian controls the money, right? Because you can have checkbook control, which is, right, checkbook control, again, we're going to run out of time. So checkbook control is where you as the beneficiary of the retirement account actually have the money in a bank account that you control. So in those cases, it's really straightforward as we described. You sign the documents, you wire the money. In other cases, you may have a custodian controlled account. And in that case, the custodian is actually the one that's going to be signing off on all the deal documents. And the paperwork that you're going to do is going to be just authorizing the custodian, telling the custodian, hey, I want to put the money in syndication A. Here's the paperwork that I'm requesting you to execute that deal. So in that scenario, your paperwork is directing the custodian, just like you can direct Schwab to buy an ETF. You'd be directing your self-directed IRA custodian to buy syndication A. And they're actually going to execute the purchase on behalf of the IRA. So there really are so many ways to set this up. Obviously, syndicators prefer the checkbook control because it really makes life easier for them. And it also makes life easier for you. And the reality is most of our clients do have checkbook control, but it's not always the right thing. And given the way we've set things up, sometimes we'll tell clients, hey, you don't need checkbook control. Our role here is not to sell you checkbook control documents. It's really to advise and guide you.
That is excellent, and a lot of amazing and important distinctions there. But I realized one great big buzzword that I let pass by is, what is a syndication? Do you want to hit that, or I could do that?
Yes. Like. Syndication is really simple. It's pooling money. It's like, hey, we've got a big deal to do. We want to take down this deal, and it's not. We want to bring together money from numerous investors, and you pool that money. It's called a syndicate. And that's what syndication is about. Now, every syndication is going to have a lead. And so that lead is going to usually be the general partner, going to be the GP. Everybody else is going to come in as LP, limited partners. The GP runs the deal. The GP is going to take some form of compensation in the deal from the deal for finding the deal, putting it together, running it, and managing it. And then the limited partners, the folks that put up the money but didn't do any of the dirty work, are going to have an equity ownership in the deal, and they get payouts based on the deal performance. So that's what syndicate is. It's just like, hey, let's take down this deal together. Let's collaborate. Let's pool our money to do a deal.
And then one of the best things about being that limited partner is that you can't lose any more than the money that you've invested. So at that point, it becomes just like investing in, say, Apple stock or GM stock. You could lose everything, but the general partners, they may have, for example, a personal guarantee on the line. Or, well, let's not get into bad boy carve outs.
Yes.
I think this would be a great time, before we open up any more cans of worms, to say that, Bernard, of all the interviews I've done, I did not expect that an interview about the tax code would happen to be one of my most enjoyable, entertaining interviews. So thank you very much for being on the show today.
George, thank you for having me. I've enjoyed this immensely. Glad to find a kindred spirit that loves operating agreements and tax code.
Thank you.